Now I'm going to do a series of videos on hedge funds. It'll be at a high level, just to give you an overview of what is a hedge fund. A lot of times you hear things like, well, hedge funds are bad or hedge funds are risky, and that may be the case in certain situations, but blanket statements don't always end up accurate. So, kind of like, are stocks a good investment? I mean, it depends. If you're Warren Buffett, then yes, they are. If you're a day trader, you might experience different results. So let's go over, first of all, what is a hedge fund. Now, most people know what a mutual fund is, and there's a little bit of confusion sometimes. What's the difference between a hedge fund and a mutual fund? Traditionally, a mutual fund is, and I'm going to talk about each country will have their own regulations. I'll speak about it from the Canadian perspective. Mutual funds generally tend to, it'll provide retail, or I'll call it retail investors, get professional management. Okay, so a retail investor would be just a regular individual. Okay, so if you are planning to invest in your own portfolio of stocks, and maybe you decide you want to diversify, you want to have 30 different stocks, and you have $1,000, you're not really going to be able to do that. So first of all, you can't split it up. Commissions would make it too difficult, even at a discount trading account. And secondly, you probably won't have the knowledge to be able to pick the 30 or the time commitment to monitor the 30 stocks. So a mutual fund is a way that an individual can hold a portfolio. So if you're going to have a chart kind of like this, you decide to buy a mutual fund of whatever type you want to buy. So it could be an equity fund, it could be a bond fund. I'm going to talk mainly about stocks for the time period, and let's suppose they'll look at 30 plus stocks. Okay, so essentially, you are the direct owner, or not the direct, the indirect owner of these stocks, and they're being managed by a manager in the mutual fund. And the manager is also charging a fee in order for you to manage it. So it's debatable whether the fee is going to be justified. Essentially, if the manager ends up performing better than the market after their fee, then this was a good investment for you, because you didn't have to do any work, you saved a lot of time, you got to diversify your portfolio, and everything is set up. Okay, so this is a good scenario for that type of an investment if it does work out. Now, because it's a retail or an individual investor, there's a lot of regulations. So you'll have things like a prospectus that you'll have to issue, which basically is a legal document that tells you about all the risks and what the fund is allowed to invest in, and how it's going to be managed. So there's a lot of protection, because most of the investors are not necessarily sophisticated investors. So what's the difference between this and a hedge fund? A hedge fund is very similar in terms of what the goal is, but a hedge fund is usually for something called accredited investors. And these would be basically things like pension funds, knowledgeable investors, or institutional investors. Okay, so it can be individuals as well, but you'd have to have a fair bit of money, and you'd also have to display that or indicate that you are knowledgeable. So as a result, this will have much less regulation than a traditional mutual fund. Okay, so there's no prospectus. There's also more leeway in terms of there's more options for investing. Okay, so the manager can do things like buy derivatives if the fund allows it, and they can also do things like short stocks. Okay, so these are things that mutual funds don't generally do. Okay, it's not written in their prospectus, and this is where all of a sudden people start thinking that it could be risky. And it can be if both of those, the reason they're excluded from mutual funds is because they do have an element of risk, depending on how they're used. If you're using them to speculate, it's clearly risky. In a hedge fund, the original concept was you're using it to hedge your risk, which would mean you're actually using it as an insurance policy to make things safer. It's not always done that way, but that's what's caused sort of the impression of them being risky. Okay? And the other difference is the fee structure in a hedge fund is usually different than a mutual fund. It's usually flat fee plus profit percentage. Okay, so an example, the most common would be a 2 plus 20. Okay? And that means you get 2% of your assets as a fee. Okay, every year you'd pay 2% of your assets plus 20% of the profit on that you make. So if you made a loss in the fund that year, the fee would only be 2%. And if you made a profit, the fee would be the 2% plus 20% of the profit.